Today, I'm joined by Head of Global Content, John Kicklighter, and we're diving into one of the key macro themes shaping global markets right now, the diverging paths of central banks as we see differing times and tempos to the next leg lower in rates. The Federal Reserve is cutting rates more aggressively now than the ECB and the Bank of England. Now, this policy shift is having ripple effects across asset classes, from currencies and bonds to equities and capital flows. So today we're going to unpack what this divergence really means. Is the Fed ahead of the curve or reacting to deeper concerns? Are the ECB and the BOE risking a policy lag or just exercising caution? And how should traders position in response? So let's start by setting the scene. John, what's driving the Fed to move faster?
Well, the Fed has a difficult position it's in. It's trying to ensure that the inflation that has been such a problem over the past year and a half continues to stay under control, but at the same time, it's starting to see a uptick in unemployment. So its dual mandate is to maintain a steady pace of inflation and a very healthy, high level employment, according to the natural rate, which isn't zero, by the way. And it's a struggle because there's a very strong argument against waiting being made by the White House, and that is leading to some very aggressive pressure, even legal pressure, trying to influence them to do what they would consider outside of their mandate or outside of their models, and ignoring inflation. So it is there's a nice balance in the economics that they usually look at. The data streams are starting to support what they're leaning towards, but I think more of what's going on is expectation, and it's being driven by assumptions by the headlines and White House, and particularly the President Donald Trump. And that is, I think, adding a little bit more interest into this than we probably would have seen otherwise, even though interest rates is one of the principal drivers of the global macro scene.
Yeah, and I think that's a really interesting point you make, because obviously that's not something that's occurring within other major economies or other central banks. For example, the ECB is not seeing that same political pressure, and the BOE neither. So, and I think the other thing that's interesting here between the positions that we are, as far as the economies are concerned, is, in the Eurozone, we've got that inflation is very much on target. I mean, growth is stagnant, but I mean, it feels like it's been stagnant for quite some time. So there's no change there. And it does give the policymakers at the ECB that luxury of being able to assess, what the US trade deal means as far as inflation is concerned and as far as growth is concerned. And I guess with the Bank of England, it's a different picture again, though, because we do have sticky inflation here, stagnant growth as well. But I mean, the Bank of England, there are questions about whether they're going to be moving again. Well, most likely not this year, given that we have that budget uncertainty and those fiscal concerns as well. But, going into next year, there could only be one rate cut that we'll be looking towards.
Yeah, and if you look at the actual benchmark rates of these major central banks, the Bank of England and the Federal Reserve are very close. They're not very far off at all, off by, I believe, 25 basis points, if you consider the range. So they're dealing with inflation and lackluster growth forecasts in about the same way, and they're set at the same levels, whereas the ECB obviously has gone very aggressive in easing up, and it's earlier in the trend. The interesting thing is, while there are divergences in these monetary policy courses right now, historically they will reconverge, and that's because the global economy has an influence on the individual economies. Very rarely do you see that you have an outlier economy that's able to just completely ignore the global trend. It has from time to time, like the Chinese economy during the Great Financial Crisis, for example. But if you see where we're at, it's more about the timing of the cycle, and if you look at the ECB, I think they moved earlier, and now they're coming to the end of their cycle, whereas the Fed was very reticent because of its concerns about inflation, rightfully so, and they might continue going into cuts, which is projected by the markets through Fed funds futures and through their own forecasts, and they'll just end later, which those changes, those differences in tempo that you talked about earlier, those are oftentimes big drivers of macro themes like you have in exchange rates. So it's not that they're totally off or totally divergent in terms of the economics behind it all, or their overall interest rate bearings all told. It's just the timing is different, and when they're willing to move, and when the pressure is building up enough, and when they're convinced of the tipping point of their particular mandate is coming into sight for them.
Yeah, completely. And it's interesting as well, obviously, how we've seen this being playing out in the markets. We've seen that US dollar weakness. I mean, that's been quite a key theme across this year, in fact, or certainly for the past few months. And then obviously US stocks are trading at record high, gold's also at record highs. I mean, what have you been particularly watching there?
The dollar is particularly interesting in all of this. Obviously, we have a more complicated picture for the dollar because it's been falling pretty much through 2025, despite the fact that it was holding and maintaining its rates, and you had its principal benchmark or peer, the euro, and the ECB was cutting rates. So that would seem to defy those expectations, but it's because the focus was more on the sell dollar, sell U.S. kind of perspective with the trade tariffs, and then it would hand over to interest rates, and that decline from the dollar would give it a significant discount in anticipation. So that's why I think that there was not a big decline from the greenback after we actually got the rate cut last week, because the markets were well expecting it and had moved quite significantly in advance of it. So now we have to see what the tempo is going to be going forward. If the ECB does level off because it's at the end of its cycle, then that contrast of interest rates will start to rebalance. Because if you look at the big picture technicals for something like the DXY, the dollar index, the trade weighted dollar index, which is heavily Euro USD, there's some major technical support that we have to look at. The floor of a multi-year, over a decade, trend line support, not to mention a much larger time frame Fibonacci retracement. So you have kind of this technical line in the sand, and you have markets that have already adjusted to what these kind of trends would insinuate. And now we have to see, all right, what's the next step? Well, it also depends on what is most pressing, what has not been priced in. If we're pricing in a steady rate of rate cuts from the Fed into the foreseeable future, then we might have already discounted a lot of that decline, and persistent declines may not continue. But if it continues to be a diversification away from the dollar because of the trade relations that the world has with the US because of the tariffs, then that will be another fundamental theme that will take over because we've already discounted the interest rate differentials.
Yeah, completely. And then I think also, as far as the UK is concerned, there is that sort of big unknown as far as the budget at the end of end of November. I mean, there are big fiscal concerns over the government's position, over their increase in spending beyond what they were expected to spend, and what that's going to mean as far as tax increases are concerned in that budget. So there is a big unknown there that I think the Bank of England hasn't been able to or can't really price for, given that it's such an unknown. That does mean I think that we're going to see, as far as the pound is concerned, potentially any upside that may have come from this Bank of England Fed divergence could actually be quite limited. And I mean, talking about risks then to the outlook, I mean, you did just touch on them. I guess, the big one here would be inflation remaining sticky as well in the US. That could be a risk to the outlook.
It could be. If we have, I mean, at the end of this week, we have the PCE deflator, which is the Fed's favorite inflation indicator. If it shows that it is picking up, despite what we've seen in some of the softening of other inflation measures, it could throw things for a loop, and the Fed may delay and following up on a rate hike with the next meeting, and may not even go in December if it does persist. Between the two, what's the bigger risk? A hastened rise in the unemployment rate because, let's say, the U.S. economy is starting to really stall out, or inflation remaining sticky and elevated? I would probably say the greater risk is probably growth, but that's not because it's a more probable outcome. It's because it has deeper uh, troubles if it does happen, because we do have a growing deficit in the United States, and we're pulling back on a lot of the stimulus-oriented efforts, which would insinuate that if we start to see the economy stall because of its core factors like consumer spending, you don't really have a good backup to prevent it from really falling apart quickly. So I would say that the greater risk is towards growth and employment than it is to inflation pressures remaining high. But again, that's not a probability thing. That's more of a potential thing, what impact it has if it does occur.
Yeah, and then I guess finally touching on positioning. I mean, long euro US dollar, caution around sterling US dollar until at least we know what the budget holds, and then also watching assets if the US dollar remains weak. What are you watching there?
I'm watching the dollar most closely, and that's because it's the principal currency, but it also has the most fundamental uncertainties around it. I think if the dollar were to move with commitment, it would probably bowl over a lot of its counterparts pretty handily, and we would see themes like trade concerns, growth concerns, or interest rate forecast concerns. They would draw their peers very readily into the exchange rate evaluation. I think that with the dollar in that really large, if you look at the technical picture again, really large wedge, looking for a commitment from a directional perspective. So actually seeing it commit to a trend, not just a creep up or down, but an actual drive with momentum. I think that is what I'm most interested in. And because I don't think you can call one fundamental motivator, because the markets themselves are confused about what they're going to focus on, what they're going to commit to. So you have to see when the collective is consolidating its view on one perspective. And you see that probably through price action more than you will through headlines or sideline conversations.
Yeah, excellent. Well, thank you so much for your time. It's great to catch up with you again, John.
Thank you.
For more videos like this, please do like and subscribe.